Hello. Going to talk a little bit about current liabilities and kind of how they're accounted for. So we're going to go ahead and open up the screen. Okay, so some typical current liabilities. Of course, a current liability is any liability that's going to be paid off within a year. And some typical current liabilities, we're going to look at them here, but would be accounts payable. It would be some of the payables related to some of the adjusting entries that were looked at in an earlier chapter, such as interest payable, for example. So accounts payable is the main one, but interest payable, other sales tax payable, we'll look at that in a moment, unearned revenues, some of your entries related to payroll would also be that, salaries payable. So a lot of different accounts are current liabilities. Now, main one we mentioned is accounts payable. And this would be whenever you did a transaction and agreed to pay for it in 30, 60 days. The supplier or the vendor granted you credit. So if we were to go buy office supplies as a business, we would debit the asset, supplies or office supplies, and we'd credit accounts payable. And then we would pay this off in the next 30 or 60 days. So accounts payable is kind of a short-term payable. It's an account that's been looked at already, but kind of a short-term payable that the company's going to pay off within 30 or 60 days. Now, also have sales tax payable, and this is a new account. And sales taxes are a way that a state or a local government will generate revenue. So let's say that we make a sale for $1,000 with a 9% sales tax. The journal entry here would look like a debit to cash for $1,090, and that $1,090 would be split between a credit to the sale for the amount of the sale, $1,000, and a credit to sales tax payable for $90. When it comes to sales tax, a retail company or a company basically is kind of like a collector, really, for the government, in that the company will collect that money from the buyers, their customers, and then we'll set it aside and then send it off to the government, however often that has to be done. Now, sales taxes are typically state and local taxes. So they're collected for the state, which then will divvy some of it out to local governments as well. So this is kind of what that journal entry would look like. Whenever the company had to pay it back, or whenever the company sends this money off to the state, they'll debit sales tax payable and credit cash, and then just send them the money that they've collected from the customers. Now, unearned revenue. Unearned revenue is whenever the company receives money in advance. It might be a deposit for a later service. It might be like tickets to a concert or a professional sporting event, because whenever a business receives money in advance, they can't earn the revenue until they've done their side of the deal. So like a professional, like an NFL team, like the Tennessee Titans, for example, they cannot recognize revenue until they play each game. So they can sell the tickets months in advance. It has to sit unearned until such time as they play the game. Then they can pull it out and recognize it as earned revenue. So let's say a company receives a deposit in advance for work that they're going to do, say, next month. They would debit cash and they would credit unearned revenue. Whenever they got to the job and completed it, then they would debit unearned revenue and credit revenue, whether it's a service revenue or a sale. Okay, now a big area here is going to be related to payroll. And payroll would be whenever a company pays their employees. And this is kind of an example. This is kind of an example right here of what a company might see when it comes to payroll. Now, there's a debit to salaries expense. And this is basically the gross pay. So what the gross pay means this is the total amount that the employees have earned. But as you know, that employees never really get the full amount that they earn. Money is taken out for taxes and various other things, and then they get a certain amount, which is known as, in this case, as the net pay. Net pay would be actually what they receive. So notice, so basically a company would debit salaries expense for the total that the employees have earned. And they would credit salaries payable for the net pay, which is the total pay going to the employees. Now, notice all the things that are taken out. And these are just a few examples. After we get through this, I'll discuss a couple of more that could be taken out as well. You've got Social Security taxes, and these are taken out at 6.2% of the first, I think, $130,000 that someone makes. And so you would take whatever they make times 6.2%, and that's what the government is taking out of your check for Social Security. Now, you have Medicare, and Medicare is 1.45% of everything you make. And so based on whatever your pay is, 1.45% of that comes out for Medicare. Now, employee federal income taxes. Now, for this class, you're always going to be given that total because it's kind of a complicated computation. Depends on how often they're paid, the employees are paid, how many deductions they've got, that they're exemptions that they're claiming, and how much they make. So it's a complicated number to come up with. So basically, the book is just going to give you this total. Now, employee medical insurance payable. Typically, companies pay a lot of their employers' healthcare benefits, but typically the employee has to pay some. And so whatever the employee is paying for medical insurance, it's taken out of their check. And that's kind of what this represents here. And then if the company has a union, they might take out the union dues. And let me go ahead and make this employee union dues payable. And so this would be union dues coming out. And so your gross minus everything that's coming out of the employee's check equals your net pay, which is your take-home pay, the amount that's put into your account. Now, notice that in all of these, they're a payable. And so again, the employer is just collecting these and then sending them off whenever they're due. So like Social Security and Medicare would be collected and then sent off to Social Security Administration whenever they're due, however often the company has to pay it. Income taxes would be collected and then however often the company has to pay it. Medical insurance, the same thing, collected and then sent off whenever the company has to pay it. Union dues, the same things, collected and then sent off whenever the company has to pay it. Now, other things that could come out of a check too, if you live in a state that has a state income tax, that would basically come out here too, at whatever percentage it is. I know some states like California, I think they're increasing it to over 16% state income tax in California. So anyway, some states, it can be very high. It can be quite a bit. If you donate to a 401k plan in here for like a retirement fund, that would also come out of your check. And also, if you're being garnished, if your wages are being garnished for any reason, that would come out of your check and then be sent off to wherever it needed to go. Typically, garnishments are for things like unpaid child support, unpaid alimony. The government, the court system will actually garnish your wages. Or if you don't pay your student loans, the government will come after you and garnish your wages. So anyway, a lot of things that can be taken out of your wages. And again, your net pay, your take-home pay is always quite a bit less than your gross pay, than what you've earned. So Another aspect of that is payroll tax expense. And payroll tax expense is simply the expense that your employer has to pay in order to employ you. And this is paid to the government. So basically, whatever is taken out of your check for Social Security and Medicare, your employer has to match. So whatever they take out of your check for Social Security and Medicare, they actually have to match. And then your employer also will pay state and federal unemployment taxes for employing you. So any money that goes into a state's unemployment system all comes from companies. They're paying that in based on the number of employees they have and what their employees make. So the state is not funding unemployment. It is the companies in that state that are funding it. So notice that typically what the rate you'll see is that companies have to pay 5.4% of the first 7,000 that all their employees earn to the state, and then they have to pay 0.6% of the first 7,000 that their employees earn to the federal government for overseeing the program. So typically you'll see state unemployment taxes payable and federal unemployment taxes payable. Another name for these are SUTA and FUTA. Just some names you'll tend to see used with these. So this is how a company would handle payroll, and this is how a company would handle payroll expense for the areas where they have to pay to some government organization for having employees. Now, some other things here: health and pension benefits. Most companies pay the majority of their employees' health care benefits. So basically, if a company is paying employee health care benefits, you would basically have a debit to employee benefits expense, and you would have a credit then to employee medical insurance payable and employee retirement program payable. So let's say that a company was paying 80% of their employees' medical premiums, then this account would be credited here. The company would recognize the expense, they would set that money aside, and then send it off to their medical insurance provider, Blue Cross Blue Shield, Cigna, whichever company they were going through to provide benefits to their employees. So this is an expense of the company. And if a company is setting aside money in a pension or matching a 401k plan, then this would be what they would do here. They would set aside that money, they'd recognize the expense, and then they would pay this off to whoever is handling the retirement funds for their employees whenever they needed to do this as well. Vacation pay. What we're going to look at here with vacation pay, and it's the same for bonuses. Bonuses is handled in very much in the same way, is that companies recognize the expense for vacation pay, and then they set it up in a payable based on what their employees have earned. A lot of companies will do it where their employees earn like 2 vacation days every month. And so the companies will just recognize the expense, set that aside, and then when the employee actually uses some of that vacation, they just take it out of the payable or clear it out of the payable. So like in this example here, you see a company is debiting vacation benefits expense for $4,000. They're crediting vacation benefits payable for $4,000. They've basically set aside $4,000 for this period due to earned vacations by employees. And then whenever an employee actually takes some time off, they would debit vacation benefits payable and would credit cash, and then this cash would be what would be paid to the employee for their vacation pay. So bonuses would be handled in a very similar way. They'd recognize the expense and recognize the payable up front, and when they actually had to pay the bonuses, then they would take it out of the payable, debit the payable, and credit cash. Very similar to what you see here. Now, warranties. Warranties are another thing that's kind of handled in this way as well. And notice again, all these payable accounts we're looking at are current liabilities. And remember, we're looking at current liabilities in this section. So another one is warranties. And warranty is whenever a seller guarantees a product. And if that product breaks, then they fix it during the warranty period. So what companies do is whenever they offer a warranty with their product, they estimate how much the cost to them is going to be. So they would record an entry like this up front with the sales. They would debit warranty expense for what they feel like they're going to have to pay out, and they would credit estimated warranty liability. Then whenever basically the customer comes in and their product needs to be fixed due to warranty expenses, then they would take it out of the estimated warranty liability by debiting it, and they would credit whatever expense was related to that. If it would be parts that they had to replace or labor costs that they incurred, they would credit that in relation to the warranty liability. So again, set up the expense, estimate the liability. Whenever you actually have to fix the product, you take it out of the liability that you've set up for it. An estimated warranty liability would also be a current liability of a company. Now, one last thing I wanted to talk about is contingent liabilities. And contingent liabilities are typically you will see these related to lawsuits. And what happens is if a company is being sued based on the probable outcome, the company may need to recognize it or make a journal entry based on that. So in the case of a contingent liability, if it's probable, if the amount of loss can be estimated, then the company would need to record that estimated liability on their books. It would be something like estimated lawsuit expense, debit, and then a credit for estimated liability, something of that nature. Now, if it's probable and and you can't estimate it, your lawyers do not know how much you're going to lose, then you would simply just disclose it in the notes. Now, if it's possible, then you would just disclose it in the notes. So if it's possible you're going to lose, but it's maybe 50-50 or maybe less than 50% chance, but there's a possibility, you would just disclose the possible loss in the notes. Now, if it's remote and it's a frivolous lawsuit, there's very little chance you're going to lose, no disclosure would be necessary. So this is kind of how a company would handle a contingent liability in this case. So this is basically contingent liabilities. Thank you and have a good day.